All right, let's talk about Amazon. The stock has taken a pretty decent hit, dropping from its recent highs. And if you're an investor, you're probably asking yourself one simple question. Is this a big warning sign, or is this the buying opportunity of a lifetime? Well, let's deconstruct the numbers and figure it out.
So that's the big question, isn't it? This is the central puzzle we're going to solve together. You see the stock price pullback, and yeah, that can make anyone nervous. But is this a red flag telling us there's trouble ahead, or is the market giving us a rare chance to buy into a powerhouse at a discount? Let's dive in.
Okay, so first up, let's look at the optimistic view, what we call the bull case. And this argument isn't just about more people buying stuff online. No, it's about a really fundamental shift happening deep inside the company, and it's all being driven by some super profitable parts of the business.
Now this table looks like a lot, I know, but it tells a fascinating story. Just for a second, ignore the line that says online stores. Instead, look at the growth projections for AWS and advertising. You see that? Those are the engines driving this huge shift inside Amazon, and that's where the real money, the real profitability, is hiding. This is where it gets exciting.
And this chart right here, it makes that whole shift crystal clear. For years, we've all thought of Amazon as just a giant online store. But look at this revenue mix. These high-margin businesses, like Amazon Web Services, that's AWS, and their absolutely booming advertising arm are becoming a massive piece of the pie. So why does this matter so much? Well, because $1 of profit from AWS is worth way more to the bottom line than $1 from selling, say, a book.
So here's the bottom line for the bulls. These high-margin engines are on track to seriously expand the company's overall profitability. In fact, models from researchers at the University of Iowa are even forecasting operating margins to get a lot better by 2026. You combine that with a more efficient supply chain, the incredible loyalty of nearly 300 million Prime members, and a rock-solid balance sheet, and the case for growth looks really, really powerful.
Okay, that all sounds fantastic, right? But it brings us to the multi-billion-dollar question. What is one share of Amazon actually worth? And this is where things get really interesting on Wall Street, with this kind of valuation duel between two totally different ways of looking at the company.
Think of it like this. On one side, you have intrinsic value. This approach basically looks at Amazon in a vacuum and asks, based on all the cash this company is going to generate in the future, what's it worth today? But on the other side, you've got relative value. And this is more like looking at Amazon in a crowd, asking, how does its price tag stack up against its direct competitors? And as you're about to see, these two methods can give you wildly different answers.
Now, the main tool for figuring out intrinsic value is called a discounted cash flow, or DCF. And I know it sounds super technical, but the core idea is actually pretty simple. You basically try to forecast all the cash a company will ever make. Then you discount that future cash because, money tomorrow is worth less than money today. It's kind of like calculating the value of every single apple a tree will ever grow, but figuring out what that entire harvest is worth in your pocket right now.
So, when analysts at the University of Iowa did exactly this, when they crunched all the numbers, what did they find? They came up with an intrinsic value of $235 per share. Now, if that number is right, it suggests the stock is seriously undervalued just based on its own future potential. But hold on the flip side, when a totally separate analysis from the Iscate repository in Portugal compared Amazon to its peers, the picture changed completely. Using a common relative metric, they found an implied share price of just over $110. And right there, that's the conflict at the heart of all this. One model says the stock is a total bargain, while the other one suggests it might actually be overvalued. So, which one is it? How can one model scream, "buy," while another one is waving a big yellow caution flag? Well, this brings us to the other side of the story, the real risks that are making some investors, a little bit nervous. All right, so let's flip the coin and look at the other side. Let's talk about the hurdles. There are definitely legitimate concerns out there that explain the stock's recent shakiness and that lower valuation. These are the headwinds we have to understand.
So what's keeping the bears up at night? Well, first, competition is getting fierce, with giants like Walmart really stepping up their e-commerce game. Second, you've got regulatory pressure building on both sides of the Atlantic. And third, there's always the fear that a wider economic slowdown could hit consumer spending. But the number that really jumps off the page, the one that makes some investors nervous, is a staggering 80% year-over-year increase in capital expenditures. That is a massive amount of spending.
But here's where things get really interesting. This is where the whole story comes together. Because that huge spending spree, it isn't just a risk. It might be the key to understanding Amazon's entire long-term strategy. It's a massive bet on the future.
See, what if that massive spending isn't a risk, but a clue to the company's entire strategy? It's not just a cost on a spreadsheet, it's a deliberate, strategic investment. An analysis from UTCLI Solutions shows that a huge chunk of that capital is being poured into one specific area, building out the AI infrastructure for Amazon Web Services.
And if this whole strategy feels a little familiar, well, it should. As this quote points out, we've seen this movie before. A decade ago, Wall Street was really worried about how much it cost to build out AWS. It looked expensive, it looked risky, but that bet paid off spectacularly, turning AWS into the company's main profit engine. The argument now is that Amazon is running the exact same play, but this time the prize is AI.
So let's break that strategy down. First, they spend billions now on the best AI infrastructure you can build. Second, they use that to make AWS the absolute go-to platform for any company that wants to build with generative AI. And this isn't just about Amazon's own AI, it's about giving thousands of other companies the tools to build theirs. Third, you attract all those high-value enterprise clients, and the result? You potentially unlock brand-new, high-margin revenue streams that could power growth for the next decade.
Okay, so let's bring it all home. With all this in mind, the high-margin growth, the whole valuation debate, and this massive bet on AI, what are the financial models actually predicting for the stock price?
So what does the final verdict from the experts look like? Well, the consensus across a few different independent analyses is actually pretty optimistic. The University of Iowa's model lands at $242. DBS Bank sets its target at $255, and the analysis from Simply Wall Street suggests a fair value of over $281. So even with different methods, they all point in the same direction. Significant potential upside from here, all driven by the belief that the long-term strengths will win out over any short-term risks.
And that leaves us with this final huge question. They say history doesn't repeat, but it often rhymes. Is the market's nervousness today about all this spending just a replay of the same doubts people had about AWS all those years ago? The answer to that question will likely decide where Amazon stock goes not just next month, but all the way through 2026 and beyond.